New yield curve inversion data. CPI missed and dollar signal deflationary crash will start in. Why TLT jumped 3.8% on Thursday is because of the bond market. No, CPI data is a lagging indicator. If the lagging indicator pointed out the downtrend, that would really confirm the downtrend is real. In this case, CPI year over year missed the expectations, dropping even lower than expected, really confirming that disinflation is already here. Inflation is on its last leg as the Fed keeps on tightening with QT and keeps on raising rates. We will get to deflation faster than the bond market thinks. There is a very good reason why we can't see deflation from the bond market just yet. Right now, there's an 80% chance of 50 basis point hike in December 14th. We have new data from the yield curve inversion showing we are very close to a deflation crash signal. Also, dollar index meltdown 6% last week is another dangerous warning signal for deflationary crash. How close are we to the epic crash, you might ask? I will show you exactly how much time we have left in the charts right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing, author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want it to be real. You want it to be true. You need to be my client, don't you? The U.S. Federal Reserve has been raising rates too quickly, and recession risks will be extremely high if it continues to do so, said Jeremy Siegel, professor of finance at the Wharton School of University of Pennsylvania. They should have started tightening much earlier. But now I fear that they're slamming on the brakes way too hard. Siegel said he was one of the first to warn of the Fed's inflationary policies in 2020 and 2021. But the pendulum has swung too far in the other direction. If they stay as tight as they say they will, continuing to hike rates through even the early part of next year, the risks of a recession are extremely high. Official data, which typically lags by a month, may not immediately show the changes happening in the real economy, he said. Most of the inflation is behind us. And then the biggest threat is recession, not inflation. Today, Siegel said he thinks interest rates are high enough that they could bring inflation down to 2%, and the terminal rate should be at 4%. I think 5% terminal rate is way too high. given the policy lags that really would force a contraction. However, that's exactly what the Fed wants, to force a contraction. As former president of the Federal Reserve Bank of Kansas City, Thomas said rates need to be higher for longer. His view is that you've got to get the rate up. If inflation is 7.7%, you need to get the rate up much higher, say 8%. They need to stay there and not back off of that too soon to where they reignite inflation, say in the second or third quarter of 2023. Wow, that's a hawkish Fed president. Now let's look at those yield curve charts. From last Thursday, November 10th, we can see the 3-month yield is now 4.18% higher than 3-year, 5-year, 7-year, 10-year, and 30-year yield. The point is short-term rate is going higher than it used to be a week ago and a month ago. Look at just 20 days ago at October 20th. The 3-month yield is obviously lower than 10-year and 30-year yield. Now let's look at November 15th, 2000 chart. You can see the 3-month yield is on top, the highest at 6.4%, higher than 2-year yield at 5.9%, higher than 10-year yield at 5.7%. That's the signal we are waiting for. Now we look at August 29, 2001. We can see that's a bottom for stocks in 2001. And the yield curve changed shape dramatic. The long-term yields are much higher than the short-term ones. Signal a near-term bottom has formed. But the yield curve that is shaped like this right now is definitely not the bottom look. I think this time we do have a lot of resemblance from the dot-com bubble, from the highest interest rates to the crypto bubble, to the crazy bear market face-ripping rallies, to the length of this bear market. Keep in mind, dot-com bubble bear market lasted 3 years. The reason being is there are so many crazy rallies in between the drops. Finally, after this week's exuberance, some context, if you're pricing in a pause by the Fed, you're overdoing it in stocks. One more thing. We've seen this chart before. We are still on track to have a 2008 style crash. Now that we know deflation is coming next. The reason why TLT was slightly down on Friday is because bonds are closed for Veterans Day. As for dollar index, DXY in mid-September of 2008, just before the big stock market crash, DXY fell 5%. Then it continues to rally higher as stocks crashing down. Same thing happened in late February of 2020. DXY fell 5%. Then it rallied up higher as stocks crashed down for 4 straight weeks. Last week, DXY fell 5% again. Where do you think it will go next? If dollar's going back higher, stocks will be going back lower again. What about long bond like TLT? The reason it's so hard to see deflation from TLT is because of the Fed's policy. When they're telling people they are continuing to raise rate, no one will want to buy TLT because they expect the bond yield will go higher. It's not until we see bond yield stop rising for 3 months we can know for sure recession is coming. The one sure bet is stock market will crash, because if the stock market can sense the recession or depression is coming caused by the most aggressive quantitative tightening done by the hawkish Fed ever since 1970s, stock will sell off because market is forward looking. We know that realistically, the only way the Fed's ever going to cut rates aggressively is when the US economy is deep in recession. And that is hardly a positive for stocks. So be careful moving forward. Stocks are going to crash within 3 months. Now I'm going to show you my client Juliana Wood's book, Burning in the 2020 Flames. And my client Taddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel. And my book, Born to Shine. And my book, again, Time. You are such a good boy for watching my video right till the end. Bye.